Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I want to share with you 10 different companies that are undervalued and have a wide economic moat. That means these companies are very competitive. They have a competitive advantage over their closest rivals and so on. If you have been investing in the stock market for a while and you have seen what has happened in the last 3 months, you might think there's no opportunities out there. But guess what? I found 10 different companies, all paying dividends. All of them have a wide economic moat, and all of them are undervalued at the moment. So I don't want to make the video longer. So I want to share with you these 10 different companies. But before I do that, join us on the Discord, join us on the Patreon account first. And InshaAllah, you can get access to this 20-page PDF that I put together recently to share with you guys. This is my first draft of many, InshaAllah, and I will be sharing with you a lot more of these things when I come back from Hajj, InshaAllah. Right, let's get to the video because I don't want to make it any longer. So we're looking at the wide economic moat today and basically the fact that it's undervalued. Those are two main focuses. And these companies are quality business. I'm not just going to bring some rubbish companies for you guys, okay, as usual. And again, before you invest in any of these companies, please do your own research and make sure you understand the business model for these companies. The first one is Intuit. We've talked about this company for a while in the last few weeks. It has a wide economic moat. It has $127 billion market cap and $456 basically price tag right now. So every share of this company costs this much. Dividend yields 0.7, payout ratio 22%, 15% latest increase, 15% 5-year growth rate, dividend year basic streak of 10 years. So that means they have increased this dividend for 10 years. The annual payout is $3.12. Safety wise is 98%, profit margin 16%, return on equity 14%, free cash flow of $4.26 billion. Total return in the last 10 years, we're looking at about 23%. Growth estimates 11%. Growth estimates for the next 5 years. Okay, so that was for next year, and this is for the next 5 years. Every single year, the analysts are expecting about 16%. 10% discounted right now, $503 per share is where the price should be. Now, this company deals with a lot of payroll software systems side of things, and apparently the US government might bring their own, and for that reason, probably the stock went down quite a bit. Maybe that's the case, maybe that's not the case, but if you're interested, look into that sort of a thing. But it looks undervalued at the moment. Another company that's undervalued that has a wide economic moat is Nike. Nike has $175 billion market cap. I did a video, basically watch the last video that I did. You will learn more about this company. But as you can see here, the payout ratio is very low for the dividend side of it. It's very low as well, 1.2. Payout ratio 11%, 5-year growth rate of 11%. They will become dividend aristocrat in about 5 years down the line. And in terms of profit margin, return on equity is it's decent, right? And especially return on equity is about 36%, which is really good. They do have some cash, $3.8 billion, 15% total return in the last 10 years. Growth estimate next year is about 23%. Then after that, it's about 9%. 18% discounted right now, $138 per share is where the price should be. In terms, the next company we're looking at is Williams Sonoma. This company has a basic $8 billion market cap. It actually went down quite a bit. It was trading quite high, very expensive not long ago, but right now it has come down. It has a wide economic moat, $122 per share right now. Dividend is almost 3%. Payout ratio is very, very low, and they have increased that dividend basically about 15% in the last 5 years on average, and the reason was about 15%. Now, in terms of cash, this is the only thing I will worry about with this company. They have a less than $1 billion basically cash, but when you look at relative to the market cap, that's not actually bad. In terms of the total return in the last 10 years, we're looking at about 10%. Growth estimates of 5%, and then 7%, basically minus 7% next 5 years. Again, that could potentially happen, or it might not happen, but it looks like it's actually quite discounted a lot right now. 40% discounted, $209 per share is where the price should be. The next one that we're looking at is Analog Devices. This company has a market cap of $94 billion right now. It has a wide economic moat, $188 per share. It has a dividend yield of 1.83%, 83%, and the increases has been absolutely brilliant. 19 years of increasing that dividend. $3.44 is what you will get. In terms of margin safety, for dividends is about 63. Normally we look for anything above 61. So profit margin and return on equity are decent. Free cash flow almost $4 billion. Total return in the last 10 years we're looking at about 17%. So next year they're expecting earnings to decline about 4%. And then after that, 6% growth every single year. 4% discount right now. $196 per share is where the price should be. The next one is one I own in my portfolio. Air Products and Chemicals. 65 billion market cap. It has a wide economic. In fact, this one doesn't have a wide economic mode. I think I made a mistake on this one. Okay, this definitely has a narrow economic mode. That's not the true. Okay, so I'm going to change that in a second. Yeah, so you can see here on Seeking Alpha, it's 4-star stock, but it's not a wide economic mode. So I'll leave that as in the thing. $288 per share is where the price is at. $2.40, 61 cents. By the way, that, yeah, I feel bad for saying this. They all have a wide economic mode, but this one actually doesn't. So in fact, I'm just going to change it now just to make sure that we're cool with that. Latest increase was 8% and then 11% increase in the last 5 years. Dividend streak 40 years, so it's heading to become a dividend basically king. Right now is a dividend aristocrat. You get $7 for every share of this company that you own. Safety 19.5%. Profit margin return equity is excellent. $65 million of free cash flow right now. 13%, 14% return in the last 10 years. 10% growth next year. Then after that, almost 10%. 8% discounted. $319 per share is where the price is at. I will love this company. I've had it for a while. I will be adding to it in the long run, inshallah. Visa is the next one. Definitely has a wide economic mode. Less than 1% in terms of the dividend yield. 21% payout ratio, which means they have a room to increase that if they need to. Latest increase was 20%. 5-year growth rate at 18%. And dividend streak of 14 years in a row. Now, profit margin return on equity for this company is absolutely brilliant. Free cash flow of $18 billion. They have more money than this company, right? Which is absolutely amazing. The whole company, they can just buy it twice with that sort of a cash, right? Total return in the last 10 years, we're looking about 18%. Next year, they're expecting the earnings to grow about 14%, then 14, almost 15%, 5% discount right now. $241 per share is where the price is at. I will definitely be adding to this company going forward. Another one that you definitely know about, and we've talked about this before, is Pfizer. It has a definitely wide economic mode. The company pays 4% dividend right now, which is absolutely huge if you think about it. Payout ratio only 26%. Latest increase wasn't that great, but it's actually decent enough, right? Dividend streak of 12 years, you get $1.64, 75% safety. In terms of safety, profit margin return equity is absolutely amazing. They have $20 billion of free cash flow right now. Apologies for that. I've dropped something. I've dropped my phone. That's the bang that you heard. Total return in the last 10 years, we're looking about 6%. Growth next year is about 8%, then 15% after that. This is according to Yahoo Finance. I'm going to double check this, in fact. Yeah, I knew that wasn't correct. So that is minus 15%. Okay. Not the, this is 5% and then basically about 15%, minus 15%. So that should be minus 15%. Oops. Okay. So I'll just put it in there anyway. There you go. So that's the corrected data, and that's 4.5%. Apologies again because I don't know what I was doing. Anyway, the 17% discounted right now and $48 per share is where the price should be for that company. Next one is Robot Technologies, another company that we talked about for a while, and it has a wide economic mode. Right now trading $456 per share. Dividend yield basically is 0.6. Safety wise is really good. In terms of payout ratio, is 17%. Latest increase was 10%. 5-year growth of 12%, and increased this dividend for basically 30 years in a row. In terms of annual payout, we're looking at about $2.73. Safety of 98%. Profit margin return equity is excellent. They have $645 million of free cash flow right now. Total return in the last 10 years 15%, 8% growth in the next year, and then 9% after that, 13% discounted. $530 per share is where the prices should be according to Morningstar. Now the next one is Starbucks. I'm sure you know this company well enough. $117 billion market cap. It has wide economic moat. One of the things I really like about this company is the consistency. The dividends has been basically increasing for 12 years, and latest increase was 8%. Although the payout ratio is about over 66%, which is huge, okay, but they do have basically $2.7 billion of free cash flow if they need to increase. In terms of total return, the last 10 years about 13%. They're expecting 16% growth in terms of earnings, 19% after that, 2% discounted right now, $104 per share is where the price should be. And finally, Estee Lauder is the next company, $73 billion market cap right now. It has a wide economic moat, trading right now about $200 per share, 1.3 dividend yield, 66% in terms of the dividend payout ratio, 10% increase last year, this year, and the 5-year growth rate of 12%, which is really good. They've only been increasing basically 2 years in a row, which is, in fact, that's based on the 2 years. It's not really 12%. Okay, for the last 5 years, it's only 2 years. So the annual payout is basically, we're looking at about 2.6. In fact, I'm going to check this in a second. Wait a second. I like to make sure I'm giving you the correct information. So dividend growth, we're looking at about 10% latest and 12 for the last 5 years. However, they've only increased basically consecutively basically the last 2 years. Okay, so that's why. And you get $2.64 for every share of this company you own. 70% safety wise. Profit margin return equity is good. $1 billion of free cash flow. Total return in the last 10 years 12%, which is absolutely really good for this type of business. And then 58% growth expected for the next year, and then 4% after that for the next 5 years, which is weird. 19% discounted right now. $253 per share is basically what we're looking at. Again, this is one of the companies that, you know, like I've always said to you guys, our wives, if you married or whatever, if you got sisters, whatever, they all go to these companies, buy this company's product without even thinking about the price and how much it's going to cost them and so on. They sell all the makeup stuff, all the product, perfumes and all of that stuff. There you have it, 10 different companies, okay? Apologies, because not all of them have a wide economic moat. However, it is just that one only. But the rest of them, it's basically, I believe, is accurate. So InshaAllah, I'm sure I've double checked it before I actually shared it with you guys. But there you have it, 10 different companies. If you're looking for stocks to buy right now and you're not sure what to basically buy, look into these companies. It's not financial advice, obviously. Make sure you learn about everything to do with the business before you invest in them. For disclosure, I do own Nike in the family portfolio. I do own Air Products and Chemicals, Visa. That's about it. Okay, so the rest of them I do not own it. This is my portfolio. I think you've seen it a million times, and I'm continue sharing. Have a wonderful day. Assalamu Alaikum.